Hey everybody, welcome to Stock Up, a presentation we're going to start doing somewhat often, but this is the inaugural episode, and we're saying inaugural because there will definitely be more than one. There's going to be lots of these, but we appreciate you for being here. Today you're going to hear from a number of Narwhal Capital Management's analysts and portfolio managers with some of their best stock ideas. As always, here is a disclosure. You can read through that at your leisure. We also have it at the website. But we're not recommending that anybody take any particular action based on what we're talking about today. We're just really kind of paying attention to some of our favorite ideas and things that we're attracted to in the market. Today, you're going to hear from five esteemed gentlemen. Obviously, the lesser attractive analysts and portfolio managers at the company will be presenting today. The good-looking ones will be hosting. With that out of the way, we're going to jump to Ben Nye. He's our Chief Investment Officer here at Narwhal Capital, and he's going to get the wheels turning with a pitch.
Thanks, Andrew. It's nice to do these in person now, at least for us. Maybe in the future we'll be able to all be together. Today we're going to be talking about a company that has historically produced a lot of cash flow, at least over the last 10 years, but that cash flow has gone relatively underappreciated because it's basically been seen as a stock that has been stuck in the mud. But what we're going to talk about today is why a lot of those issues are in the rearview mirror and why it's accelerating to recover its old potential and really find new glory. And that company is General Motors. It was founded in 1908, went bankrupt in 2009, and had a bunch of issues between 2009 2013 when this current CEO, Mary Barra, who is an engineer by trade, she worked at GM for a multitude of decades before becoming the CEO. When she became the CEO, she was dealing with a company that was still partly owned by the US government. It had a magnitude of lawsuits related to ignition switch issues that ultimately settled for billions of dollars. And it was just a company that couldn't really find its feet after its bankruptcy. It had a lot of pension liabilities. But over the last 5 to 7 years, what Mary Barra has done is that she's really simplified the company. They've exited Europe, and they've really now simplified into 4 key divisions. The division that we all know and are familiar with is GM North America. And that is its businesses, especially in the United States, which is its typical automotive business. In addition to that, they have the international division, which a lot of it is the equity investment in China and in Chinese vehicles. And then finally, third, they have the GM Financial division. And the GM Financial division is where it provides financing to leasing and to dealers for floor plan inventory. And then finally, they have the cruise business. And I think the cruise business is one of the more underappreciated businesses, and that's where we'll start. This is their self-driving autonomous vehicle division that it owns a majority stake in, but also has key investments from other entities. So as a background on driving automation, there are 5 levels of driving automation, really 6 if you include the zero automation. And where most cars are today, even most self-driving cars, they're at level 2 automation. This is the automation that Tesla claims to have. And that is where you need significant driver supervision in order to successfully pilot the vehicle, even when it's in self-driving mode. Where GM's Cruise is very strong is in a level beyond that. So this is a list of miles driven that are driven at level 3+. If you notice, Tesla is not on this list, and that's because Tesla, even with its full self-driving, is only level 2. GM's Cruise has driven 770,000 miles in 2020 alone, with 28,000 miles between times where humans have to interfere. So it and Alphabet's Waymo, which is also the parent of Google, they're really the leaders in full autonomous driving at the present time. And this business currently doesn't make money. It's marginally negative to profitability right now. But the equity stake that GM has in the business is also supplemented by equity stakes from Honda, Microsoft, SoftBank, T. Rowe Price. In fact, Walmart actually invested in Cruise just a few weeks ago alongside Microsoft and Honda. And based on those valuations, you're talking about $10 to $15 a share in Cruise value alone. The current CEO of Cruise is Dan Ammann, who was the prior CFO of GM under Mary Barra from 2015 to 2019. He left that position to actually go and lead the entire business at Cruise. So this is a business where I think there is somewhat underappreciated value that really should be added in to the valuation of GM in total. Second business here is GM North America. The key element here is, if you can see on the gray line, the margins have been structurally improved, both overall and in North America. Overall, it's been helped by the exit of Europe, which is a very low margin business. But in North America itself, margins have improved and were actually even improved in 2020, despite the recession and a lower revenue. So the strategy here has been to streamline the portfolio with profitable vehicles and build modular vehicles that can really scale effectively. Over the next 5 years, the company is betting big on electrification. The Hummer electric vehicle is coming out in the fall of 2021. Reservations are full, both for the pickup and the SUV that'll come out in early 2023. You have the Cadillac Lyriq coming out first half of next year. And then the Chevy Silverado electric vehicle with a 400-mile range is expected to come out in early 2024. These are just a few of the 30-plus electric vehicle launches that are going to be had by 2025. And GM is really leading on electric vehicles, as well as we saw earlier on autonomous vehicles. And I think that really supports its valuation of GM North America going forward. Third business is GM International. A lot of people will overlook this one because a lot of that just comes in below the net income line on the equity income. But that accounts for almost $1 billion a year if you annualize that number. And that is really formed through its 14% market share in China, through its partnerships and joint venture partnerships with local manufacturers. And this is, again, solid value where they're a major player in a major economic hub. And 14% market share is a strong business position in the international markets. And China sales have performed very well so far this year. You add that all together, and right now the guidance for overall GM automotive income this year is $11 billion, but that includes almost $2 billion in chip shortage headwind costs. So if you normalize all of that out, you're looking at a valuation of between $80 billion and $120 billion for the GM automotive business. So this is the GM North America and GM International. It's important here to note that while I did include the Volkswagen and Ford multiples, I think those are spurious because there are a lot of other businesses that dilute that result. And I think the ones to really look at are the pure play manufacturers like BMW, Toyota, and Honda. So you look at that, and that's how you get to their about $100 billion valuation for the GM automotive businesses. And then finally, you have GM Financial. This is basically GM's captive bank that provides retail financing, leasing programs, basically trying to make it easier for people to buy a vehicle. They also offer commercial lending products to dealers. And if you look at the assets minus the liabilities of this business, you're talking at about $7 a share in value. So the way you get to a valuation here is just you add up all the sum of the parts. So you add up the cash, you add up the value of Cruise, you add up the value of GM Financial, and you add up the value of the GM automotive business, subtract out the debt, the pension, and you get a valuation of about $71, $72. But if you also say that these chip shortages are not going to be a permanent thing, and those chip shortages are going to normalize over time, then that changes the valuation of the GM auto business, and it also changes the valuation of General Motors itself. So instead of a valuation of $72, you're looking at a valuation of almost $100. For a stock that's trading right now at $56, that's substantial upside, and that's why we like the stock both this year and going forward over the long term.
Awesome. Thank you, Ben. Next up, we have Jason Sieb. Jason is an investment analyst. He's been with us for about a year, relatively recent graduate from Vanderbilt. And we've heard one pitch. Now he's ready to let another one fly here with Southwest Airlines.
Hey, I'm Jason. I'm excited to get in front of a lot of you guys for the first time. And here's my presentation on Southwest. So brief history on Southwest. The company was founded in 1967 by Herb Kelleher and a couple other guys. And the idea that they had was to build an intrastate airline to service Texas. So basically they were flying exclusively between Houston, San Antonio, and Dallas. And they did that for a while. And then in 1979, they started going to states nearby. And then in 1990, they really became a national airline by starting to fly to the East Coast and the Southeast, and eventually to the West Coast. Today, they fly over 700 planes to over 100 destinations, carrying 134 million passengers in 2019. Obviously, the pandemic cut that down significantly in 2020. And they only carried 54 million passengers in that year. So looking at where Southwest stacks up in the industry, they currently have the second largest market share to American. They passed Delta this decade to become the number 2 player in the industry. But where I think they really stand out is in their quality combined with that quantity. So as you can see on the right, this is from the Wall Street Journal. It's their 2020 Best Airline Scorecard. And Southwest was ranked the number 1 airline in the country. And American, which is the only airline that flies ahead of them, came in last. So this scorecard used data and research based off timing, lost baggage, pricing, basically anything that you would think about and having a quality experience with your airline, they evaluated. Southwest came in number 1 overall. So why is Southwest an attractive investment? They have the industry best management and operational team. They're gaining market share, as I kind of just alluded to, and they're also a reopening play from COVID. So looking at the management team, they have the best debt and cash management in the industry. Right now, their net debt number is actually 0, which means that they have equal amounts of debt and cash. So one of the ways that they are able to do this is by focusing on operational efficiencies. As you can imagine, the airline business is very capital intensive. You got to pay for the planes, you got to pay for fuel, and you have a lot of employees doing a lot of complicated jobs. So Southwest excels here in multiple ways. The first one of which is they only fly one model of plane. That's the Boeing 737. And they've only flown that model since the founding of the company over 50 years ago. That helps them because 1, it allows them to save costs on training, maintenance, operations by just having to run one model. And 2, the 737 is the most fuel efficient model. So that allows them to save money on fuel costs, which obviously make up a significant line on the income statement. Another way that they are efficient is through their system design. So again, you can see on the right, the top map is Delta's map and the bottom map is Southwest. Delta operates what's called a hub and spoke system, where they have a few central hubs throughout the country that almost all their flights go through. So you can see on this map, Atlanta's the biggest. They also fly to Minneapolis, Salt Lake City, up to New York. And so if you want to fly, for example, from Cincinnati to Charlotte, you would most likely fly through Atlanta to get there on Delta. Southwest doesn't think that that's very efficient, both from a customer experience perspective and from an operations perspective. That's because the most complicated and expensive part of a flight is taking off and landing. So by doubling the amount of times they have to do that, you're spending more money. So they operate what's called a point-to-point system, where you can fly pretty much if they have a location, you can fly to one of their other locations. Obviously, they do have a similar hub. They have locations that they fly to more, but for the most part, I think these graphs are pretty self-explanatory. And the efficiency of that plan shows up in the data, as Southwest is the industry leader in both margins and return on invested capital. Southwest management team has been very smart with acquisitions in its history. They've only completed 3, and they used them to expand their market share pretty aggressively. So they used acquisitions to expand to the West Coast. And then in 2011, they bought AirTran, which gave them access to the Atlanta market, which is obviously a very important airport. It gave them access to international markets. And it also pushed them ahead of Delta to become the number 2 airline in the country. And so the great job that the management team has done can be seen in the stock performance. Compared to the big 4 airlines, so that's American, Southwest, Delta, and United, their stock has outperformed the other 3s over 1 year, 3 years, 5 years, 10 years, and 20 years. Pretty much any time period that you want to look at, Southwest has done the best. So right now they are continuing that trend and aggressively expanding their business. This is something that they've done during past recessions. So during the .com crash and the financial crisis, where other airlines, shrunk to stay alive, Southwest was in a good enough financial position going into it that they could expand. So in 2020, they added 4 destinations to their network. And in 2021, they're adding a total of 10. The interesting strategy here is that they're adding in domestic leisure destinations. So they've added some at smaller coastal beach towns. So think Sarasota, Hilton Head, Santa Barbara. They've also expanded to ski towns. So they're going to Colorado Springs and Steamboat Springs. And then lastly, they're also going to national parks. So they are now flying to the airports closest to Yosemite and Yellowstone. They're also expanding to cities where they were previously only in 1 airport, but now they're going to be in 2. So in Chicago and Houston, they used to be in Midway and Lobby respectively. And now they're also going into O'Hara and Bush. So that will position them well to serve corporate customers, which I'll talk about in a second, as well as that's a direct challenge to the airlines that already dominate those airports, which is primarily American and United. So the last opportunity here is as a reopening play from COVID. I divided this up into 3 stages. Stage 1 is domestic leisure. This would be driven by vaccines. And as you can imagine, after being cooped up in your house for a year, people were itching to travel. So in February, Southwest went up 32%. So I would say that this stage of the reopening has already happened for the most part. However, we still are below full capacity. So there is some upside there, as I'll talk about in a second. Stage 2 is international leisure. Southwest serves 14 international markets, mostly in Mexico, the Caribbean, and Central America. 8 of those are currently open, and the rest of those becoming open will be dependent on the local governments. The last stage, and the one that provides the most upside still, is corporate reopening. So 35% of Southwest passengers in normal times are business customers. Those type of customers on average have higher profits because 1, they are more likely to pay for premium tickets, and 2, they book later. So prices are higher at that point in time. That business was down 90% in 2020, which is much more than non-corporate customers. And however, the industry consensus is that this will take a lot longer time to come back than leisure. However, I kind of view this as a positive because you can kind of think of it as a ladder where we're getting upside from domestic now. We'll have upside from international end of this year real soon. And then over the next year to 3 years, we'll have upside from corporate. So looking at the valuation, revenue is still down over 50%. And it's projected to still be down similar levels compared to 2019 through the summer, although obviously improving. In the most recent quarter, Southwest had a loss of about $2 per share before the government provided aid to them. And based off my calculations, I am projecting 1.58 earnings per share full reopen quarter, which would be about 630 per year. And then going off Southwest historic PE ratio of 12, this would give us a share price of just above $76, which would be 27% upside from current prices. So those are the reasons that Southwest is an attractive investment right now. Thanks.
Excellent. Thank you, Jason. We are about to halftime of this performance. We've listened to 2 stock pitches. We're going to take a little bit of a break here from stocks and talk more about the fixed income side of the world and hear a bond idea from Tom Russell, our director of fixed income. So if you need to use the restroom or refresh your drink, anything like this, this would be a great time to do it. As a reminder, if you have questions, shoot them to us in the chat and we will address those at the end. We'll get the analyst that spoke on any given company to come address questions at the end. So if you have any, have at it. But with that, I'll turn it over to Tom with a bond idea. We'll see if he sinks or if he floats.
So no one's going to have any idea what I'm talking about here, but we're going to talk about some unusual bonds today that we're using to really hedge against the potential for inflation, the potential for rising rates, and kind of deep diving into a very unusual space in the bond market, which would be sinking floaters. So what is a floating rate bond? So it's basically a bond that is tied to a benchmark and not a fixed coupon. So if you think of like variable rate mortgages, you're basically, pegged for a certain period of time. And then after that, you float based on a benchmark. And that's basically what we're looking at here, but in reverse, we're getting paid on that. So typical benchmarks are things like LIBOR, CPI, Muni PSA, but basically you're going to float on a spread to a benchmark. And one advantage of these bonds is they pay quarterly, and also the coupon resets quarterly as well. And so you've got a little bit more fluctuation within the bond. So why would I want a floater? Rates are exceptionally low. And if I'm getting a spread to a benchmark that is also a rate, why would I want to do that? And the first is that they're a natural hedge to interest rates, which is essentially as interest rates rise, you're going to get compensated more and more on these bonds. And so they're extraordinarily out of favor because we all know that interest rates are at historic lows. The second is that there's not a ton of demand for them at the institutional level because the way they're quoted from a price standpoint looks horrendous. And so if I'm running a mutual fund for the average bond investor who doesn't want to buy individual bonds, if I buy a floating rate muni, the SEC standard is what's called yield to worst. And that's the worst case scenario, the least amount of money you're going to get paid on a bond. And on floaters, because rates are so low, they look really, really terrible. But what we know about floaters, and I'll talk through this later in the presentation, is that yield to worst is an impossible scenario. And therefore, we need to look at the actual scenarios that are going to happen with this bond. And we can find some opportunities for exceptional outperformance, particularly if rates do rise. And then, of course, you've always got the possibility that, you can get sunk out or called early, which we'll also talk about. So as always, when we look at bonds, and you'll probably see this a million times over the next 10 years as we talk about bonds, but we look at it from 5 lenses. And this is really going to fall under the structure and price lens. We're looking at unusual structures and we're looking at prices that are extraordinarily depressed right now in relation to the market at large. So here's an example bond, and this is something we own for quite a few clients. We've got about $2.725 million in face value on these bonds across 22 accounts. And the average price that we purchase these bonds is $92.75 per bond. And you can kind of look through over here on the Bloomberg description page, and you can see how the bond is structured, which is that, we've got a AA3 or an A1 credit, depending on which rating agency you're looking at. We've got national insurance. So we've got over-the-top security on the bond should there be any problem with covering the coupon, or in a default scenario, we have insurance. So there is an additional layer of credit quality on top of that. The coupon, which is sort of stored towards the middle, shows that we're getting a 3-month LIBOR multiplied by 0.67 and then adding 0.55% on top of that. So if you kind of run through that math real quickly, we're looking at about 68 basis points right now on the current coupon, which is extraordinarily low. And we'll talk about how that affects the yield on the bond going forward. But things to notice over on the right-hand side in purple is that this bond is callable on a 30-day window. So they can call it at $100 per bond anytime with a 30-day warning, as well as we've got what's called a sink that starts in 2023, which we'll talk about over the next couple of pages. What a sink is and how that can be a net benefit to someone who owns a bond. So first we'll talk about yield to worst. And this is how, if you were looking at this bond, it would be quoted on a yield basis. So we bought these bonds today at the current price that we own on average for clients at 92.75. The quoted yield is going to be 1.28%, which would be an annualized return for 23 years, which is only about 60% of a 23-year treasury. So you could basically go out right now and buy a treasury significantly higher. You could even just buy a brand new issue 30-year treasury, and you get about double that yield. And you have that on AAA basis, so you wouldn't be taking any credit risk at all. And so when you look at that, you'd be like, why would I buy that? That's a terrible yield. I'm locked into a really low amount of payment for more than 2 decades. But we know, based on the structure, that is an impossible scenario. And why is that? The first is going to be those sinks that we talked about. So a sink is a portion of the bond that gets called out at par every single year once the sink schedule begins. And you can see that on the right. We've got bonds coming out every single year starting in 2023. And the advantage there is, as those bonds are called at par, you're actually getting better and better yield each time that happens. So in 2023, if this bond gets sunk out, every bond in that portfolio that is redeemed at par, you're going to make 2.19%, which is 1,300% of treasuries on a 2-year basis, because the front end of the curve is essentially at zero. So if you're buying 2023 bonds, you're maybe getting 0.25% on some exceptionally squirrely bonds that are probably pretty low credit quality. So you can basically get 13 times a comparable treasury in 23. In 24, you're going to get almost 500 times a comparable treasury. 25, 250% roughly. So you don't really hit a point where you're making less money on the sinks until 2029. 13% of all of these bonds are going to be off the table, paid in full before 2029. And so we know that our risk level is going to be decreasing because we're going to get better returns and we're going to get our money back sooner. And that still assumes that there is no increase in the coupon at all in that scenario. So if you get both, you get, say, rate spike, you get more coupon, plus you get the sink out of par, you're going to be making more money each and every time this bond pays a coupon. The next scenario here is the coupon itself. Right now, we're looking at 0.67% in terms of what it's actually paying on a quarterly basis. And you can see kind of on the right-hand side how that's been coming down as rates have come down. But we know over the lifetime of this bond, the average coupon is actually almost double that at 1.33%. And so assuming that we don't get sunk out and we don't get called early, we know that the average coupon is much, much higher than we are right now. And so for context, when this bond was out there during the housing crisis, it was paying 4.35% quarterly. During the previous Fed liftoff, it was paying almost 2.4%. And at peak LIBOR, you would have been paid 7.5%. So rising rates are going to make this a very, very, very attractive bond. And here's our best case scenario. And this is actually what we've seen across the book with a number of the floating rate bonds we've purchased over the last 12 months, 18 months. And that's that we're getting hit on this 30-day call provision. So that bond basically means that you can buy something for $92.75, and in 30 days, you're going to get paid $100 for it, plus accrued interest. And that's really our maximum upside scenario. And the best part about that is that resets every single day. So any given day, you can get called back out in these bonds at par on a 30-day schedule. So here's just an example using the same yield assessment calculation from Bloomberg on the right-hand side. If this bond was called in 2 months on 7/15, you'd have an annualized yield of 50.34%, which if you break it down is going to be your 7.25% closed to par, which means you get all that principal back. Plus you're going to get the interest that's accrued over those 60 days. So you basically make 7.39% inside of a 45-day window in a scenario where the average 30-day treasury is paying you 0.0001% on the same time period. So that's really our best case scenario. And that's what we've seen on a lot of these bonds. And that's kind of that built-in pop that we're looking for. So while most of our bonds are going to be very traditional bonds, this is basically baking into the cake potentiality for maximum upside and maximum outperformance. And so here's an example. This is the exact same municipality. This is another bond that we owned in large quantities, and it actually was called on that 30-day provision earlier in the year. So if you look at the description page, the LIBOR calculation, 0.67 plus 53 basis points, it was set to sink starting in 2024. We own $3.24 million of this at an average price of 91.5 across 39 client accounts. And the entire issue was called in full at par on 317 of this year. And I can tell you that we actually made the final purchase on the open market of this bond the Friday before it was called at $92.50. So we made 7.5% over a weekend on a single bond for one lucky client. But that's what we're looking for. We're looking for opportunities where we get early return capital, excessive yield compared to comparable treasuries. On top of that, these are federally tax-free bonds. And so that's what we're looking for. And that's why we're looking at floating rate bonds. And in the bond space, I think it's probably one of the best bets going forward and a place where we can look for excess value.
Awesome. Thank you, Tom. Great stuff there. We are now going to switch gears back to stocks. Vincent's coming up here in just a moment, or as we call him, the analytical beast from the Far East. And he's going to be pitching Facebook to see how many likes he gets.
It's true. Good afternoon, guys. Glad to be here. And excited to talk to you about Facebook today, which is one of my favorite stocks at the moment. It is, quite simply put, a great business at a great price with lots of optionality attached to it. To talk a little bit more about Facebook's business, Facebook controls 4 platform assets, namely the Facebook Blue app, Instagram, WhatsApp, and Messenger. In addition, it owns Oculus, which is a best-in-class VR, AR business, as well as a 9.99% in Jio, which is India's largest mobile provider. I believe these assets benefit from great network effects, giving the business a resilient moat. The following are some statistics that demonstrate the power of Facebook's platform. Through the last 11 years, monthly active users for Facebook has compounded at roughly 16% per year, with only one down year in one region. Daily active users have followed monthly active users very, very closely. In addition, Facebook's daily active users to monthly active user ratio as a proxy for user engagement has actually expanded from 54% in 2010 to 66% in 2020. This company is not valued on eyeballs either. Facebook has successfully monetized its user base incredibly well, growing worldwide advertising revenue per user by 24% through its 8 years as a public company. No other social media company has remotely come close to that. Growing its users and monetizing well is a recipe for success. And this has led to outsized revenue growth of roughly 37% year over year through the last 8 years as a public company. Paired with an incredibly stable margin profile due to strong competitive dynamics, and despite contracting in recent years due to regulation, the company was able to grow its EPS and free cash flow per share at 33% and 35% through the past 11 years. And today, more than 2.7 billion people use one or more of Facebook's platforms each day. And more than 200 million businesses use Facebook as a means to reach their customers. Hundreds of billions of goods are sold through offsite e-commerce driven by Facebook. Oculus, a market leader in a high potential area that could potentially become the next platform. And the least talked about asset in the entirety of Facebook is WhatsApp, which has a very, very real chance of becoming a super app in select regions, which is modeled by Chinese super apps as like Tencent's WeChat. People often overlook most of Facebook's active users are actually outside of the US at the moment. And we believe monetization of these users are just getting started. Going forward, we expect further monetization following the rise of social commerce. In addition, we expect monetization of WeChat to be finally happening. As a result, we expect advertising revenue per user and monthly active users for all regions, not the United States, to grow rapidly. We expect ARPU and monthly active users to stabilize in the US. Now let's talk about valuation a little bit. We are getting, quite simply put, we are getting this business at a market multiple, while it is significantly better than the average business, and it's growing roughly twice as fast. So why is Facebook so cheap? Put simply, we believe investors are fixating on two near-term issues that we believe exist remedies for. Number one is that investors believe the recent Apple privacy changes will have unfavorable effects on Facebook monetization efforts. And the counter to that is we believe ads are evaluated on a relative ROI basis, and Facebook is still very, very well positioned to deliver the best-in-class ROIs to advertisers, even with this change. Number two, and it is what you hear in the media headlines a lot, Facebook attracts significant regulatory scrutiny. Antitrust probes, billion-dollar fines are no new news. And quite simply put, this is why a highly competitive advantage business that is growing revenues at 30% year over year is available at a market multiple. This is why we are paid to take this risk. And quite simply, I am happy to take this risk on. Talking more about absolute valuation, we think Facebook can conservatively to roughly $20 in EPS by the year of 2023, which translates to roughly $400 per share by year end 2022. That represents an 18% IRR through that time period. Thank you.
Excellent. Thank you, Vincent. Last up, we've got Sam Frost. Many of you know Sam. He's been with us for a while. I don't know how long, multiple years. And Sam is here to pitch Disney, though he may be our smallest analyst. He's not mousing around with this pitch.
What an intro. All right, so Andrew just spoiled it. I'm here to pitch Disney. I think most of you guys are probably pretty familiar with this company and probably think of it as a reopening story, which is definitely a catalyst. But due to the success of the successful launch of Disney Plus in November 2019, Disney has undergone a bit of repricing to the upside due to the ability to monetize this new platform across its other business segments. Such the run-up that we've seen over the last year is justified, in my opinion. I think it's still got room to go. So just as a quick overview of Disney's operating segments, which are pretty straightforward, you have the media networks, which consist of traditional TV, such as the Disney Channel, ESPN, Freeform, FX, National Geographic. You get the picture. Next, you got the direct-to-consumer. That's the newly launched streaming service for Disney Plus, ESPN Plus, and Hulu. Then we have the parks and experiences and products. I think you guys can figure that one out. We got the Disney theme parks and resorts, cruises, vacation clubs. It also consists of the consumer products, where it sells its branded merchandise through a host of retailers. And then finally, we have studio entertainment. This segment consists of, is the filmmaking unit. So it's Walt Disney Pictures, Marvel, Lucasfilms, Pixar, and a couple others. And so looking at the bottom of this slide, I think there's a couple of things that stand out. The first one is that the media networks and the studio entertainment. So you can see from 2018, 2019, 2020, their revenue and their operating income basically stayed flat, if not grew a little bit, basically showing that even a global pandemic couldn't affect these business units, which basically means we don't have to worry about these two guys. We think that they're going to continue to do well moving into the future. The other one, though, is parks and experiences. So parks historically have made up about 40% of their net sales and about 45% of their operating income. Due to COVID, they had a serious fall last year, which resulted in an operating income loss of about $81 million. The third thing that stands out, you got the direct-to-consumer segment, which basically is just steadily losing money. So basically, we have two clear catalysts from looking at this chart, which basically says we got to get parks to be profitable again. And the other thing is the direct-to-consumer segment either needs to generate a profit or create a profit, as we'll kind of see later in the presentation. So first, looking at the parks, this is your typical reopening play. Good news for us is that Disney has confirmed that they are headed down this path. So Disneyland in California reopened on April 30th. Disneyland Paris is set to reopen on June 17th. And then Disney's also in line with the CDC guidance. They're considering expanding capacity, removing the mask mandates, stuff to kind of make the experience a little bit more enjoyable. Additionally, we got Broadway shows coming back in September. And then, according to a CDC spokesperson, cruises should return by mid-September. The next thing we can see is that analysts are actually, that chart at the bottom, analysts actually are forecasting that revenue and operating income are going to nearly fully recover by fiscal year 2022, back to the pre-COVID levels that we saw back in fiscal years 18 and 19. And just so everyone knows, Disney's fiscal year ends in September. So we don't have to wait it's not even till the end of fiscal year 2022. We should start seeing that coming through sooner rather than later. And then for the direct-to-consumer unit, I stole this quote from New Constructs. They're a research platform that we utilize here at Narwhal. They said the Magic Kingdom is the streaming industry's winner. And I think they're right. And so basically, Disney has an unmatched ability and opportunity to monetize their direct-to-consumer platform. What this means is that Disney's profitability is not dependent on streaming success like the other streaming players. Take a Netflix, for example. Although Disney expects the streaming business to be profitable by 2024, profits aren't the point for this business. The main point is that the streaming offers another entry point to the Magic Kingdom's monetization platform. Despite this, though, Disney's been performing well in the streaming space. From 2019 to 2020, Disney grew its market share from 7.3% to 13.3%, while Netflix market share fell from 19.1% to 18.5%. However, additionally, I guess, Netflix, they can't match Disney's budget content budget forever. So Netflix jumped their original content budget up to $19 billion for 2021, while Disney is planning to spend $14 to $16 billion per year by 2024. The issue is that Netflix is a mono-channel business, and they won't be able to monetize this content as well as Disney will, which basically means that they're going to struggle to keep up with Disney and their content production and their spending. Further, you got Disney produces better content than Netflix, so they're getting more bang for their buck. And as you can see from the chart to the right, Disney was responsible for 7 of the top 10 films that were streamed in the U.S. in 2020, while Netflix only made the list 3 times. To be fair, I guess I got to throw this in there. Netflix does a good job on the series category. The problem is that it's mostly licensed content. It's not original content. So 4 of their 5 top streamed shows were actually licensed shows. And then you got Disney's Mandalorian, which has performed extremely well. I know it's a popular show here at the office. I'm sure a lot of you guys have seen it at home. And then the good thing is Disney's actually committed to producing a bunch more Star Wars series, and they got a bunch of other original content that should be competitive. And so speaking of the licensed shows that Netflix does so well with, there's no secret that there are more and more players getting into the streaming space, which basically comes with companies pulling their licensed content from Netflix, which puts a larger emphasis on original content. And this will also commoditize the space, and it's going to push down margins. Fortunately for Disney, as I mentioned earlier, Disney is not dependent on streaming profitability and has the means to run this business at a loss, basically effectively forcing out the new entrants while monetizing this streaming business through its other channels. The perfect example of the monetization is the high demand that we've seen at Hollywood Studios in Disney World down in Orlando. They opened up the Star Wars themed section of the park, which just had crazy demand. And so this is directly due to them acquiring Lucasfilms, reinvigorating the Star Wars saga, which is what we're continuing to see today with The Mandalorian and the future shows that they got coming out. It just kind of illustrates their monetization abilities. So next, we got Disney at an attractive price. It's currently down 15% from its recent high of about $202 a share. This is partly driven by the most recent earnings announcement, in which they largely met analyst expectations. Across the board, they had a small miss on new subscriber ads for Disney Plus. The good thing, though, is that Wall Street is still bullish on the stock. As you can see there, we got 26 buys, 6 holds, 1 sell. And a lot of this bullishness, as you can see to the chart to the right, is due to the growth that Disney has seen in Disney Plus. They got more ads than Netflix over the last 5 quarters. So all good news. But if we dig into the valuation a little bit deeper, we can see that, 205 might not be the ceiling for Disney. They got a little bit more upside to go. So basically, we have this quick and dirty valuation metric that we use on Bloomberg. And if you look at that, we got a price target of about 160. So maybe a little bit overvalued, but not excessively so. This form of relative valuation basically compares the multiples of peers and how large the discount or premium has been over the past 2 years. So if you look at that first multiple, we got Disney's PE ratio for next year, basically. Historically, they've traded at a 44% premium to their peer set, and right now they're at a 48% premium. And so what this does is it basically says, all right, 44% premium to the peer group, we're going to throw that's an implied 33.6 times multiple, and we come with this $164 price target. And so then we just take the average of these guys. It comes out to 160. Again, barely, shows that they're currently 5.5% overvalued. Not bad at all. Good thing for Disney is the price of free cash flow metric there at the bottom. A mature company like those guys should be priced on free cash flow, which is basically right in line with where they're trading at now. So next, we're going to look at these multiples and kind of see what's been going on. And this chart's just a few of their multiples, and it shows that they've undergone some repricing that kind of started in 2019 and accelerated through 2020. And the big part of this, in my opinion, is the successful launch of Disney Plus back in November of 2019. And so with this, we got to think of Disney now as two separate companies for valuation purposes, because we all know Netflix is valued differently than a free cash flow machine like Disney. So then we kind of compare Disney and Netflix on a price to sales ratio, since those guys, Netflix, streaming guys will be compared or priced on sales. What we can see is Netflix is trading at a higher multiple than Disney. That's the green line up there. And we can basically just take the median of Netflix's price to sales ratio, and we'll see that 6.8. And I think it's fair to value Disney Plus based on that, given that Disney Plus has had stronger growth than Netflix has. They got the good content creation. So remember that number, and we'll use it on the next slide for the valuation. So finally, we got the valuation. I'm going to answer the question everyone wants to know: what is Disney worth? To do this, we got to break it down into two parts: everything except for the direct-to-consumer segment, and then the direct-to-consumer segment by itself. Starting with the direct-to-consumer, starting with everything but the direct-to-consumer. We've illustrated that the park segment should return to the pre-COVID levels by fiscal year 2022, while the media and studio segments have proven to hold steady over the past years and are forecast to stay steady moving forward. So what we can do is we can look back at 2019. We can use their enterprise value to EBIT multiple from back then, and then just assume that they just redo 2019 with those numbers, and we can apply that multiple, and we come up with $151 a share, which is good because, again, it's not too far from where they're trading at now, of about $169 a share, which means the direct-to-consumer doesn't have much to make up to close this valuation gap. And so then we move on to the direct-to-consumer. Again, we pull that 6.81 multiple that we pulled from Netflix. And then we apply it to the 2020 direct-to-consumer revenue number of about $17 billion. And to be clear, they're forecast to grow, moving forward through 2021 and 2022. But just for the sake of conservatism, I went ahead and kept the 2020 number. And so we see that Disney Plus is then valued at $63.56 per share. And so then we just simply add those two numbers up, and we get $214.83 for a price target. I think there's basically, I would say, it's probably going to nail $214.83. That's all I got, but it's about 27% upside. I think it's a good buy opportunity.
Excellent. Thank you, Sam. Thanks to all the analysts that we had on the call. Really appreciate you being here, all that good stuff. We are going to try to launch a poll here if I can stop the screen share. Here we go. So we're launching a poll here. Feel free to submit your vote in terms of which company you are most interested in terms of performance over the next 12 months. We'll leave it live for about 30 seconds to see what you have. In terms of chat, no questions submitted. So if you got anything, send it in very, very quickly and we will answer those. But we're getting the polls. Man, I'm watching the bars jump all over the place. We will end the polling, share the results. So GM, 7 people say GM, 39%. Jason Seed coming in second with Southwest Airlines at 17. Shockingly, Tom, the boring bond guy, getting 17% of the vote. Disney coming in with 4 votes at 22%. Facebook last. Ben, we do have a question. This comes from Akash.
Ooh.
Oh, Tom, you got a question next. Akash asks, does the EBITDA guidance for GM Auto depend heavily on top line growth on automotive sales? Were auto sales strong this past year from the stimulus, or were people not really buying new cars? So in light of the stimulus, what's the impact there? And then we'll throw it to a question for Tom.
Yeah, so if we go back to, I wonder if I can share again. So you can see the revenue last year was actually down, and that's on the GM North American business. And again, that's because people weren't able to access the dealerships. Now, that is expected to increase. The street estimate right now is for $106 billion in revenue from the North America business this year. The margin is going to be a little bit compressed because of the chip shortage, so they're seeing a little bit more on the cost side. But I guess to quickly answer your question, the stimulus didn't really have a big impact on actual revenue because so much of the inventory was drawn down. I actually think that's going to be a latent boost to revenue over the next 2 to 3 years as they replenish inventory at dealer lots and continue to sell up to that pent-up demand. So I guess short answer to the question is people weren't buying as many new cars last year because being shut in more than offset the additional stimulus. That demand has come back in 2021, but the chip shortage is hurting the potential for sales, and that should normalize going forward into 2022 and beyond. So the expectation there from our view is that sales for GM North America is going to increase over the next few years.
Thank you, Ben. And before Ben gets a big head, I think it's really important to note that it was actually Jason Sieb that pitched General Motors as a purchase here internally. We got a question for Tom. Why would a municipality call a bond if it is trading at a discount? Are they deleveraging as a result of infrastructure stimulus, or is it more situational? What really drives people to call a bond? You know, in the example that you gave, when it's trading at $92 or whatever it may be.
I think it's a number of things. I think specifically with the floaters, it's avoiding a potential blow up. We saw just a ton of these things come off the board in the early part of the year when rates spiked. And, fearing inflation, fearing rising rates, they just want to kind of lock in. And with rates being exceptionally low still, they're just issuing new bonds with a fixed coupon of, call it 1.5%, 2%. Most new muni bonds are coming out with extraordinarily low coupons. And not only that, they're selling them at premium. So you could essentially issue new bonds paying 2%, get paid $115 a bond, and then turn around and pay off those bonds, and you'll end up netting ahead. So that's really the action that we've seen on a lot of these. And additionally, what they can do is they can also issue taxable municipals at extraordinarily low rates as well, which have been sort of the new area of the market. They don't have to directly refund those bonds. They can issue new taxable bonds. They've got fewer hurdles to jump through and less cash they have to have on hand to pay those bonds. So we've seen a lot of new taxable issuance as well that's been taking up a lot of these floaters.
Awesome. Thank you, Tom. And I think that kind of makes sense when you think about it. A lot of it on the municipality level in terms of their decision making, a lot of it really comes down to just cash flow. If they're paying for these things, whether it's off essential services or off revenue and general taxing ability, whatever it may be, sometimes if they get a concern that their interest payments are going to go up, if they can get that amount of payment lower, by reissuing bonds, paying off the previous debt. They're going to do that. It's kind of like if you had a mortgage and you knew you ultimately had to pay $300,000 at some point, but you could get your payment down, you might go ahead and do that. So I think that's part of how they're thinking about it. I don't see any more questions, so we are going to wrap it up there. We really appreciate you guys joining us. We will be doing this, as we said, periodically, and just kind of highlighting some of our best ideas, specifically ideas that are actionable across client portfolios. As always, we do have our morning market briefing. If you have questions on that or want to know how to join, you can join us at narwhalcapital.com/briefings. And that is where we have our morning 8:30 call. It's on Zoom. We hit the big topics every day, and we try to talk through the biggest stories and try to make them make sense to people as it relates to their actual portfolios. So thanks again for joining us. Thanks to the great work from all the analysts and portfolio managers, and we will talk to you all, some of you, tomorrow morning at 8:30.